Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss the Fed's outlook and headwinds the economy is facing. Michael, it's great to see you as always. And let's kick it off with the market activity and sort of what investor sentiment was like going into that all-important FOMC meeting this week.
Right. So we saw the major equity indexes selling off into the Fed meeting on Wednesday and then continuing to sell off afterwards. And we also saw the 10-year Treasury yield move up to 3.7%, which is the highest since 2011. And the 2-year is up to 4.2%, which is the highest since 2007. The interesting thing is that the Fed hiked by 75 basis points, which was priced in. So the market reaction is more to the Fed's comments and projections.
And let's talk about that. The market is following the Fed. The Fed is following inflation, and quite honestly, the economic data is starting to decline a bit here.
Right. So if you recall, the markets have been kind of struggling to price in where the Fed is headed. So from June through August, there was some recession worries with the negative Q2 GDP print, and then there were some weeks where initial claims were moving up. So, with recession worries, people thought maybe the Fed won't hike as much. So the market estimates for the peak Fed funds rate moved from 4% to 3.3%. But then in August, when the unemployment rate's still staying low, inflation isn't improving too much, Fed officials started to push back, made it clear that inflation is their big focus right now, particularly Chair Powell at Jackson Hole, where he kind of implied that recession is an acceptable trade-off to get inflation back to 2%. So from that point, we started seeing markets pricing in more Fed hikes, getting the expectations for the terminal rate up to about 4.5%. And from that August into September period, we've seen a sell-off in equities and bonds. But we also saw that markets didn't go quite far enough based on the Fed meeting, where the Fed is actually projecting getting to 4.6%, and also projecting the unemployment rate to rise to 4.4%, and the kind of rise from where we are now at 3.7% to 4.4%. Is what would typically be associated with recession.
And let's talk about housing headwinds, Michael, because that really was the bright spot, the housing market over the past couple of years. And we're starting to see headwinds there as well, particularly with rates where they are now well over 6%.
Right. So the Fed moves so far haven't been that effective in impacting inflation or the labor market, but they've been very effective in impacting the housing market. So we've seen the 30-year mortgage rate increase to 6.3%. That's up 320 basis points this year alone. And so in reaction to that, we've seen existing home sales decline for 7 straight months. We've seen building permits drop 20% this year. And now we're also seeing month-on-month declines in home prices, which is something that we haven't seen in over 10 years. And then based on the higher interest rates and the impact that could have on demand, we could see home prices decline, 10% in over the next year. So that, the one concern is if this is another kind of 2007 style situation. It's not. We don't have all the adjustable rate mortgages, and lending standards are much higher than they used to be. So that concern would be unfounded. But the good thing would be that lower home prices will help the Fed in their bid to battle inflation. And since housing and related kind of spending accounts for about 15% of GDP, a slump in housing alone isn't enough to cause a recession.
Well, Michael, answer this. Do you think the Fed is being too aggressive? Because as you have explained to us before, that these interest rate policies and the hikes associated with it do take time to play out through the system. And we're seeing how the market and the economy is responding, yet the Fed is potentially planning 2 more rate hikes. Do you think it's being too aggressive, or should they let these policies play out a bit? What are your thoughts around that?
I think the Fed's made it very clear that they're going to do whatever it takes to get inflation back to 2%. And if that means causing a recession, that's the cost of doing business. And their bias is going to be hiking too much, not hiking too little. So I think if there is a risk of overdoing it or underdoing it, it's definitely balanced towards overdoing it.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.